Tesla's sales decline, what it means for the EV market. Alert: Tesla's China-built electric vehicle shipments plunged by 8.4% in July, marking a significant shakeup for the automaker's global ambitions. In plain terms, deliveries of the Shanghai-produced Model 3 and Model Y, whether sold domestically or exported to Europe and other regions, totaled just 67,886 vehicles last month, down sharply from a year earlier. Why is this happening? Local competitors such as BYD, Xpeng and NIO are rolling out lower-priced EVs that are quickly winning over Chinese buyers. At the same time, Europe's appetite for Tesla imports remains muted, prolonging a sales slump that some analysts thought was nearly over. And this is the part most people miss. As Tesla presses ahead with ambitious price cuts and new factory expansions, it may be sacrificing margins and brand cachet in the Tesla's Shanghai factory decline, EV competition in China, and investment strategies. Let's face it, Tesla, once the uncontested king of the electric vehicle EV space, is now facing a storm in one of its most critical markets, China. The company's Shanghai Gigafactory, which has long been a symbol of its global manufacturing prowess, recently reported Tesla's market share in China has dwindled to 6.5% in the first half of 2025, down from nearly 9% in 2024. Meanwhile, domestic players like BYD, Xiaomi, and Xpeng are gaining ground at an astonishing pace. BYD alone captured 35% of the market in 2023, while newer entrants such as Xiaomi and Xpeng have rolled out models that are capturing consumer attention. For example, Xiaomi's SU7 and Xpeng's G7 have collectively garnered over 300,000 pre-orders, directly challenging Tesla's Model Y and Model 3. These companies aren't just competing, they're outpacing Tesla by leveraging localized research and development, aggressive pricing strategies, and rapid production cycles. But here's where it gets controversial. Is Tesla losing its edge because of external factors? Or is it struggling to adapt to a rapidly changing market? Consider this. BYD's sub-$10,000 EV, dubbed the Seagull, has turned the heat up on price wars, forcing Tesla to slash prices and introduce 0% financing deals. While this might help retain customers in the short term, it comes at a steep cost. Tesla's automotive gross margin plummeted to 13.59% in Q4 2024, the lowest it has been in years. To make matters worse, Chinese EV manufacturers enjoy state-backed subsidies and tax incentives, giving them a significant cost advantage that Tesla simply cannot match. For global investors, this raises some tough questions. First, there's the issue of margin pressures. Tesla's reliance on price cuts to maintain its foothold in China signals a troubling trend, diminishing pricing power. As margins contract, so does investor confidence, which is evident in the company's underperforming stock. Second, there's the risk posed by Tesla's heavy reliance on its Shanghai factory, which accounts for 78% of its China Plus deliveries. With exports from the facility dropping by 22% year-over-year, investors need to ask whether Tesla can successfully pivot toward higher-margin international markets like Southeast Asia and Europe. Finally, regulatory uncertainties add another layer of complexity. China's recent One Big Beautiful Bill Act, which eliminated EV tax credits, has shifted consumer preferences toward more affordable models. This policy change puts Tesla's premium positioning at odds with the market, whereas local competitors like BYD and Xiaomi are better aligned with evolving consumer demands. So what should investors do? Here's a roadmap. First, consider rebalancing portfolios to include resilient Chinese EV players like BYD and NIO. These companies are not only thriving in their home market, but are also better equipped to navigate the complex interplay of regulatory changes and pricing dynamics. Second, keep a close eye on Tesla's innovation pipeline. Initiatives like the stripped-down Model Y and the much-anticipated robotaxi could reignite growth, but execution risks remain high. Investors should closely monitor these developments to gauge Tesla's ability to stay ahead of the curve. Lastly, don't overlook global macroeconomic headwinds. High interest rates in North America and Europe are dampening EV demand, adding another challenge to Tesla's plate. A diversified EV portfolio with exposure to emerging markets like India and Brazil may offer better risk-adjusted returns. In conclusion, Tesla's shipment decline from its Shanghai factory is more than just a regional hiccup. It's a reflection of the broader evolution of the EV market in China. While Tesla's technological leadership and brand equity remain strong, it's increasingly being outmaneuvered by local players who understand the nuances of the market better. For global investors, the key lies in striking a balance between Tesla's long-term potential and the growing resilience of Chinese EV startups. The next 12 to 18 months will be pivotal. If Tesla fails to regain its pricing power or deliver groundbreaking innovations, its market share in China, and perhaps its global dominance, could face irreversible erosion. What do you think? Will Tesla rise to the occasion, or are we witnessing the beginning of the end for its reign in China? Share your thoughts in the comments below.